What's going on, everyone? My name is Andrew and welcome to Real Estate Basics. Today, I'm going to teach you how owning real estate can actually save you money. Now, I must preface this with I am not a tax professional or anything along those lines. This is purely for entertainment purposes, and I strongly urge you to seek advice from a licensed professional. Now, bear with me because this can be one of the more confusing aspects to real estate, so I'll try not to get too much into the weeds and just touch on the basics. We'll start with tax write-offs. Typically, these are operating expenses that are associated with running your investment property and are written off against your investment property income. Some common examples include interest, property taxes, insurance, utilities, HOA fees, property manager fees, repairs, and CapEx. And other examples include travel to and from your properties if you live out of the area, and professional fees, amongst other items. There are a lot of different things that could be written off for tax purposes, but be sure to check with your CPA to make sure you have the proper justification. So how do tax write-offs work? Well, let's say you had a rental that cash flowed $10,000 per year, but your expenses for that year included these items which add up to $11,000. Now remember, your cash flow already accounted for all your expenses, so you didn't actually lose $1,000. However, to the IRS, they see on paper that you lost $1,000. Now, another thing that we can include in our tax write-offs is something called depreciation. Basically, the value of the building and other depreciable assets can be included in your tax write-offs to show a further loss to the IRS. So for example, a cost of a building is depreciated over 27.5 years. Now, there are many rules that apply to depreciation, such as what time of year you put your rental in effect. So how is showing the IRS that you had a loss for the year good? Well, since again we showed an overall loss and not a gain, our rental income is not taxed and is therefore tax free. Q, passive activity loss. Passive activity loss allows owners to deduct rental losses from their active income, thus further reducing the taxable income of the owner. Now, there is a $25,000 limit, which will depend on your income. We'll get to that in a second. And this $25,000 limit will apply regardless if you are single or if you are married for tax purposes. Owners with an active income of $100,000 or less can deduct up to $25,000 in passive activity loss from their active income. Quick example, a person makes $100,000. They have 3 rental properties whose combined passive activity loss is $25,000. Well, their new taxable income is now $75,000. Now, above $100,000, the amount of passive activity loss you're allowed to have will start to phase out up to the point of a income of $150,000, above which you can no longer use passive activity loss to lower your active income. And how this works is for every dollar that you make above $100,000, your allowable passive activity loss reduces by 50 cents. Here it is in equation form. To show you how much you can save on your taxes using passive activity loss, I set up a simple spreadsheet that shows your income over to the left, your maximum allowable passive activity loss based on the equation, which we've already established, showing what your new taxable income would be, assuming you are able to actually prove that you had passive activity loss up to those limits. And then we get into showing what your federal income tax would be before taking that passive activity loss and after taking that passive activity loss, resulting in these federal income tax savings. So you can see if you're single for the 2021 federal income tax brackets, if you make $100,000 and you're able to deduct up to $25,000 in passive activity loss, you can save almost $6,000 in your federal income tax. Now remember, this $25,000 limit applies whether you're single or married. So you have very similar, albeit different, federal income tax savings for the married bracket. So what happens when our active income is greater than $150,000? Well, in short, you can still show a net zero to the IRS, making your rental income tax-free. And there is another way that we can get around this limit to deduct passive activity loss from our income, which is the real estate professional exemption. Now this is going to get a little complicated, so stay with me. If your income is greater than $150,000 and you can prove that you meet these requirements, you could in theory deduct up to $250,000 if you're single, or $500,000 if you are married. To qualify as a real estate professional, you must participate in at least one real property business, participate in that business in the day-to-day operations, spend at least 51% of your annual work time at the business, and spend at least 751 hours per year working at that business. Now, if you meet these wickets, you have to follow the rules of the real estate professional exemption, but proving that you can meet these requirements is very difficult, especially if you have any other jobs outside of real estate. Now, there are some other rules that we can use to our advantage, such as suspended passive losses, accelerated depreciation, and methods for how to best optimize your tax write-offs and deductions, amongst other things. But this is a conversation best had with your CPA or licensed tax professional. That's it for this one. If you enjoy this content, please like and subscribe. And until next time, take care.